The meeting to order, and the first order of business is roll call, please.
Henry Jones.
Here.
Richard Costigan.
Here.
Margaret Brown. Here. John Chung, represented by Steve Orez. Here. Rob Feckner.
Morning.
Good morning. Richard Gillihan.
Here.
Dana Hollinger.
Here.
Priya Mather.
Good morning.
Good morning. David Miller.
Here.
Ramon Rubalcava.
Here.
Pardon me. Bill Slayton.
Here.
Teresa Taylor.
Here.
Betty E. Excuse me. Thank you.
Okay.
Richard Costigan, I don't think. Yeah, I don't think she did.
Did you get Mr. Costigan? She did?
And you
Okay.
too.
Okay.
For the first two.
Oh, you were the first one?
Yeah.
Oh.
Okay. Okay. Thank you. So all are present. Okay, thank you. We're going to skip the Chief Executive CII report, rather, to later in this morning, and we're going to go to item.
Chair?
Yes.
I have a point of order.
Yes.
Yeah, good.
Thank you.
Turn your mic on.
Turn your mic on.
Oh, you have to turn it on.
Okay. Hold, wait a minute. Push it back. Okay.
Thank you.
Ms. Brown.
I need to know whether I might be subject to arrest for trespassing for being here today. I was informed by the board president on Friday that she claims to have the authority to lock me out of the board chambers on certain days, and it's not clear to me.
Ms. Brown, point of order. Ms. Taylor.
Wait a second. Not on yet.
You should double click it, Mr. Chair.
Okay.
Great, thank you. This is not on the agenda, so this is not appropriate time for this to be discussed right now.
Okay. That's, I think that is the rule, and so it's not appropriate to discuss it at this time. So we need to move on.
Turn it off.
Okay. Okay. Now back to the agenda. I'm going to pull item 4E from the information consent items. As I understand, we have a request to speak on this item. This item is CalPERS' report to the legislature on outcomes of our constructive engagement activities with portfolio companies involved in the construction or financing of the Dakota Access Pipeline. CalPERS take issues related to universal human rights, including indigenous tribal rights, very seriously. In fact, in response to recent events as part of item 6C, the committee is considering a proposal to enhance CalPERS' governance and sustainability principles to clarify our commitment to the UN standards of free, prior, and informed consent. I'd like to acknowledge staff for all the hard work that went into these engagements and review of our principles. Compilation of this report is in response to the passage of Assembly Bill 20 by Assemblymember Ash Carler, and if I'm not mistaken, he's in the audience. I know he's in the audience here, and he will be speaking to you shortly. So, Mr. Carler, you are free to speak. Thank you.
Thank you, Mr. Chair and members. It's really a privilege for me to have the opportunity to come here after the passage and signage of AB 20. AB 20 was a bill that I authored literally moments after being sworn into office, and it initially started as a divestment bill regarding the Dakota Access Pipeline project. In hearing concerns, not just from the CalPERS board and staff, as well as some of my fellow members, Assembly members, I continue to work on the bill rather than stick to the principle of divestment and allow the bill to die. On that principle, I thought there was something constructive that could come out of the bill and the conversation that ensued. So ultimately, the bill required the boards of CalPERS and CalSTRS to submit a report to the legislature and governor regarding investments in the Dakota Access Pipeline, and to also review and consider factors related to tribal sovereignty and indigenous tribal rights as part of the board's investment policies related to environmental, social, and governance issues. I'm very grateful to the committee and the board, and especially grateful to your wonderful staff who have done a tremendous job in the directive from AB 20 in doing what I believe to be a groundbreaking report. Had it not been for AB 20 and working collaboratively with the CalPERS staff, our state's institutions would continue to sit out of a particular global conversation surrounding responsible investment. The Equator Principles is a risk management framework adopted by financial institutions for determining, assessing, and managing environmental and social risk in projects, and it provides minimum standards for due diligence and monitoring to support responsible risk decision-making. The Equator Principles are adopted by 92 banks across the world, including Barclays, Bank of America, Citigroup, Credit Suisse Group, HVB Group, Rabobank, JP Morgan Chase, and Wells Fargo. These banks underwrote approximately $14.5 billion of project loans in 2002, representing approximately 30% of the project loan syndication market globally, and certainly as we're 16 years subsequent to 2002, I imagine that number is much larger today. And so the Equator Principles, I think, allow us the opportunity to work with the banking industry to determine how we, not just as CalPERS as a state, but really California and the nation thinks about these same principles when investing. These are principles that these banks are already considering when they invest internationally, however, had not been considered necessarily in terms of investments here in our nation. And so I'm very grateful and would like to thank CalPERS and CalSTRS for being open to the dialogue surrounding the environmental and social responsibility of the financial institutions that uphold our government and our values. And I'm very grateful to the committee chair and members for allowing me the opportunity to pull this item off consent to express my gratitude to your staff.
Thank you very much for your comments, and thank you for your presence today. Okay, we will now go back to our action consent item. The minutes needs to be approved. If we could get approved by Ms. Taylor, second by Mr. Koskinen. Questions, discussion? Seeing none, all those in favor say aye. Aye. Opposed, hearing none, the item passes. The information consent items, no additional items were there where I have a request to pull anything from that area, so we will now move to item 5, review of investment committee delegation.
Thank you and good morning.
Morning.
The board's governance policy requires an annual review and affirmation of each board committee's delegation. Item 5A is the review of the investment committee delegation. The only change proposed is to reflect the recent appointment of Ms. Mather as the new board president. And red line is included with your board packet. And this is an action item specifically for the committee to recommend for the board's review and affirmation of this item at its April meeting. So with that, I'll pause for any questions.
Okay, seeing no questions, this is an action item, so do I have a motion? Moved by Mrs. Mather, second by Mr. Koskinen. Further discussion? Seeing none, all those in favor say aye. Aye. Opposed? The item passes. We now will move to revision of real assets program policy, second reading.
As a reminder, staff reviews each individual program's investment policy on a roughly annual basis for any indicated changes. Item 5B is a second reading of staff's proposed updates to the investment policy for the real assets program. There were no comments at the first reading, so this draft is identical to the version distributed in the February IC. and this is an action item. So with that, I'll pause for any questions and invite comments from PCA, Makita, or Wilshire.
Okay, seeing no questions from board members, are there any additional comments from the consultants?
No additional comments from Wilshire at this time.
Okay, thank you. Okay, so a motion is needed. Moved by Ms. Taylor, second by Ms. Mather. Discussion, seeing none. All those in favor say aye. Aye. Opposed? Hearing none, the item passes. Thank you very much. We now will move to the consultant's review of ESG integration. And Ms. Wilshire and Associates. Oh, before, come on down, Wilshire, but before you make your comments, I'm going to call on Mr. Eliopoulos now to make his introductory remarks.
Thank you, Mr. Jones, members of the Investment Committee. My remarks, traditionally at the beginning of the meeting, have moved before items 6A, B, C, and D, and really that underscores our focus in this March Investment Committee meeting on governance and sustainability. That was intentional as we put our agenda together, that in the spring and in particular in March, we would focus the annual review as well as other substantive items in our governance and sustainability work. Investment Belief 2 states that a long-time investment horizon is both a responsibility and an advantage, but also requires us to consider the impact of our actions on future generations of members and taxpayers. It is for this reason that we have developed a sustainable investment strategy, because our first priority is to protect the fund's financial sustainability. It is how we will protect the pensions and benefits of our members. In 2016, the board approved a strategic plan for sustainable investment, which both prioritizes our resources and our efforts over the following 5-year period that the strategic plan governs. The plan itself reflects, in addition to Investment Belief 2, Investment Belief 4, which states that long-term value creation requires the effective management of 3 forms of capital: financial, physical, and human. Now, we underscore these topics many times, and we've heard these words, but it's meaningful to cover them again and underscore them as we consider these agenda items 6A through D. So I'll spend a little bit more time talking again about why it is that we consider these issues. Physical capital is the environment, the basic resources and infrastructures that the companies and people that we invest in need. It's why the E in ESG matters. Companies rely on inputs from the physical environment, but also have an impact themselves on the physical environment, with an example being carbon emissions. Both inputs and impact will vary by sectors. Managing environmental risk, as well as the opportunities they provide, is vital for the long-term performance and sustainability of the portfolio. Human capital is how economists traditionally think about the role of employees, the impact of supply chains, and more broadly, how companies manage their relationships within the communities within which they operate. It's the S in ESG. Financial capital and its impact is why the G in ESG matters. Good corporate governance is vital to ensuring an alignment of interest between a company's management and its share owners. In our long experience at CalPERS, companies with good governance practices deliver better long-term value to their investors. Effectively managing the physical, human, and financial capital requires us to consider the risks posed by the many topics under the rubric of ESG, as well as consider the opportunities that might be provided by the impact of the many topics and issues within the rubric of ESG. And that really is why we spend today, and particularly agenda items 6A through D, to look at how we as an organization, how we as an investment office focus our efforts on how to integrate the many varied topics under the rubric of ESG into our portfolio. On the agenda today, you just heard from Assemblyman Kolra on the requested report from the California legislature to CalPERS on engagement around the Dakota access pipeline. I'm also pleased that today and shortly we'll be hearing from Wilshire, the board's independent fiduciary consultant, on their first review of the CalPERS ESG integration efforts in this item. I fundamentally believe it's very important for this board to have an independent and expert assessment of CalPERS progress along all of our programs. And we're looking forward to hearing from Wilshire today on their presentation to the board and the discussions around the issues that the review has highlighted for further consideration. That's item 6A. Next in line, we'll have a first progress report from our own investment staff on the 5-year ESG strategic plan. That's agenda item 6B. This report sets out the progress that we've made against the KPIs the board agreed to when the plan was adopted by the board in August of 2016. It's our first check-in and an opportunity to assess how the plan is being executed. We'll be giving a progress report on each of the main substantive strategic priorities that are outlined in the strategic plan. In particular, we'll have a deep dive on climate change and board diversity projects. It's also an opportunity for us to check in on a wide range of other issues which we've addressed around governance and sustainability. As part of our core workload, we're often asked and often proactively look to respond to emerging issues, and stakeholder requests is an important part of our work. And the last year has certainly brought out many complex issues for us to examine. Among those issues are highly sensitive and important issues, such as the response of companies to the tragic loss of life through gun violence and the growing societal debate on firearms safety. We will be covering in detail how your investment staff have responded to those issues to date. We have also had requests during the course of the year to address other issues, such as executive compensation, clawbacks, the Dakota access pipeline, which has prompted serious efforts of engagement by your investment staff across our portfolio and with many companies that we do business with. Other topics brought to our attention by stakeholders include product safety, geopolitical risk, in light of concerns in countries such as Turkey, South Africa, and regions including the Middle East and the Korean Peninsula. In addition, as we'll see in agenda item 6C, we continue to make our way through the list of outstanding issues from our board review of the governance and sustainability principles that we undertook in 2016. As promised, we're coming back each year with proposed new language on substantive topics that were highlighted as parking lot items during that year-long review. And this year, we'll be coming back with important new proposed recommended language around indigenous peoples' rights, following up on the Dakota Access Pipeline engagement, as we heard briefly this morning. We're also introducing language that deepens and broadens our principles on environmental issues, focused mainly or much in a large degree to capture the impact of the Paris Accord, as well as our other work on climate change. Last, in this series of items under Agenda Item 6, we'll complete a detailed review of CalPERS proxy voting, share owner campaign, and corporate engagement. We've listened to the committee last year during last year's review, and we're providing much more additional detail to set out how we've been supporting both management and share owner proposals, plus trend analysis, so that the board can see how the work is progressing over time. Mr. Chair, thank you so much for the time to set the stage for these important agenda items, 6A through D. I believe we have much time within each of these discussions to go over the specifics of each of these, but I thought it important at least to set out the outline of what the committee would hear so that we'd all have the context for the day.
Okay, thank you very much, Mr. Eliopoulos. We will now move forward to the presentation. Just a minute, we have a question. Mr. Costigan.
Thank you, Chairman Jones. Mr. Eliopoulos, I just wanted just some observations. So the volatility in the market, again, the market's down 300 today. The Feds are talking about raising interest rates by 1/4 of a point. They're looking at 4 interest hikes this year. So I just want more of a sort of a global perspective right now. What should we expect over the next several months? The continued volatility, do you see volatility continuing? Do you see the raise in the rates softening that? I assume a raise, we're seeing, again, wage potential, inflation has been low. Just, again, interest in the observations as we move into some of these afternoon discussions.
Sure. As I pointed out, I believe it was last month, some of the months yes. tend to blend together. I and the staff do expect more volatility in the coming calendar year and the years to come. We're coming off on a very unusual period of low volatility, as we've discussed many times in the investment committee. The setting for this year is one of the drivers of low volatility coming out of the financial crisis was the sheer amount of quantitative easing that the various central banks around the world have pumped into the marketplace. That quantitative easing is now signaled to be coming to an end. The U.S. certainly is withdrawing the amounts of QE. The Bank of Japan and the European central banks are also signaling withdrawal of quantitative easing over the course of the next 1 to 2 years. That macroeconomic environment, the taking away of capital from the punch bowl at a time when valuations are at elevated levels and volatility has been at a low, signal that going forward as this monetary policy reverses quite substantially, that we should expect more volatility going forward as these monetary policies play out. And I'll just underscore one other, I think you have another question coming, but in addition to that, we are at a period at the very, in late stages of our economic cycle in the U.S. And the other factor that we're monitoring quite closely is the addition of fiscal stimulus at the time of a late economic cycle. So the administration's tax policy, as well as other stimulus to the economy and an infrastructure program, is quite an experiment, and there aren't many times in history to look back at this collection of macroeconomic conditions. The withdrawal of a massive QE program at the same time as a long and sustained economic cycle is coming to the end, and a late cycle fiscal stimulus are interesting phenomenon and new, and lead us to believe we should have more volatility going forward over the next few years.
Well, that just goes back to, we sort of have a triple witching hour a little bit. You have a new Fed chair. We have Mr. Kudlow coming in, who seems to take a different view of the world than his predecessor. And then you have Mr. Navarro, sort of an American first, and I do hate the word nationalist, but more of a internal centric view of the world. And so when we look at volatility, I mean, what I'm trying to get at is long-term planning, and you have taught us well, long-term will be fine. It's just trying to understand the short-term volatility between Kudlow coming in, the disagreement that he's currently had on, as you were talking about, Mr. Eliopoulos, the months begin to blend together. Last month we were talking about tax cuts. In the intervening 30 days, we've now got tariffs. We've had sort of a change in the Feds. We've had the market have a correction, a recovery. Maybe it looks like another correction going on. We've had the economic advisor resign. You brought in Mr. Kudlow, and then you've got Mr. Navarro, and then Mr. Laffer today is commenting on a second round of tax cuts coming forward that would lead to even more economic growth. I don't know if you want to opine on any of that, but that is something over the next couple of months I would ask you all to sort of keep track on, Mr. Jones, because given Mr. Kudlow's various statements, and then particularly Mr. Navarro's, and I believe he's out of UC Irvine, it's going to have some effect on the overall portfolio.
Your points are very well taken, and adding new trade policy to that list of unusual and new circumstances is certainly worthy.
Yeah, and thank you, Mr. Koskinen and Mr. Eliopoulos. Yes, keep us updated as we go forward on the Federal Reserve activities going forward. Appreciate that. Okay, Mr. Junkin.
Thank you. Good morning, Andrew Junkin with Wilshire. I will just be speaking very briefly just to kind of give an introduction into this next item and to Daniel specifically, kind of laying out the framework. And having now worked with CalPERS for 13 years, I've been around through various iterations of ESG, and while CalPERS has long been viewed as a leader in the ESG space, the approach has really changed quite a bit. And I think it used to be very targeted, almost ad hoc with the CalPERS effect and the focus list companies. And I think for me, a tipping point really occurred when the investment beliefs were adopted and it became more formalized, but it was still, initially it was kind of asset class by asset class, and it was almost a checklist at the beginning as people were learning about the process, and I think it's really moved towards full integration, and Daniel's going to spend a lot of time on that today. Historically, we've commented on ESG integration as part of our asset class reviews that you get on global equity and fixed income and forest land and real assets, but never really addressed it holistically across the total fund until now. So by way of background, Daniel Ingram has been with us for about a year now and has joined Wilshire as our ESG expert and really has a background as an ESG practitioner. So someone that has been a peer of much of your ESG staff and can really dig deeply into these matters that require the kind of expertise that you're going to see today. So with that, I'm going to turn it over to Daniel for the rest of the presentation.
Thank you, Andrew. Thank you, Ted, for the introduction, particularly around sort of clarifying some of the terminology that we'll be using, environmental, social, and governance. It's probably worth just plugging our paper that we've published in the past week or so, somewhat provocatively titled, "Where's the F in ESG?" And the F very much there is about trying to help investors find the financial in some of these, what can occasionally be slightly more squishy, hard to understand, broader concepts, but very much linking them back to the financial materiality. That's really what that paper's about, and happy to kind of answer any questions on that paper further down the line. I'm just pulling up the slides here. The purpose of our presentation really is to give you all some constructive feedback from Wilshire's perspective on two things: CalPERS people and its processes on ESG integration. And slide 7 here, if I can just put it onto, okay, well, if you all have slide 7 in front of you, just hopefully helps to set the context for this. So the scope of the review, we couldn't cover everything as much as we'd like to in this first review, so we deliberately designed a very narrow scope. So we're focused, like I said, on ESG integration, which is different to divestment. It's different to impact investing. We're not today going to be talking about some of the, commenting on CalPERS' broader sustainable investment choices. We're not going to be talking about the efficacy of the divestment program.
We'll get it. Just keep
Okay, I'm going to carry on, and other areas, we're not going to be talking about investment performance of CalPERS ESG investment strategies. But going forward, we would really value the investment committee's input and staff's input on what's been helpful about this review and how it could be expanded in different ways, and what areas you would find helpful for us to look into. So just a first note on our process, information gathering. I came up to the CalPERS office, spent 48 hours with around about 20 staff. I wanted to understand their roles, their responsibilities in this space. Thank you, Andrew, and others. We now have slide 7 up on the scope and process. The second step of our information gathering was a bit more innovative in that we went into the Principles for Responsible Investment database. As you know, sustainable investing really is a relatively new emerging area, and therefore the data sets by which we could compare CalPERS to was somewhat limited, but PRI represents a good opportunity for us to delve into what some of your peers are doing. So we went in there and decided we needed to define a peer group, which again is not easy. Given CalPERS' size, its complexity, we settled on a North America peer group. We felt that was sensible, perhaps more sensible than looking further across the globe, and we felt that size was an important determinant, so we took a cutoff of $100 billion. And it's worth saying there are some holes in the assessment, in the database, in the disclosures, but it's the best we've got at the moment. The second area, in fact, I'll move on from the scope and start really, I think, all the way right at the end of the presentation. I tend to find it's good to get right to the punch points, and so if we flick to slide 17, what are we on? Sorry, yeah, slide 17 here. We thought it'd be helpful to walk you through the 3 main considerations and give you examples really of why we formulated these recommendations, and maybe give you something to think about going forward. The first question we asked is, how can CalPERS ensure that its future strategic objectives on ESG are aligned to its resource planning and its internal capabilities? Second, have we got the right balance and coordination between dedicated ESG resources in the centralized teams, ESG resources working within investment teams, and investment staff working on ESG issues for just some of their time, say 10 to 20% of their time? And then lastly, how can CalPERS create an innovative investment culture on ESG which helps to nourish the future leaders around ESG for tomorrow? So I thought it might be helpful just to backtrack a little bit onto slide 8. Slide 8 is one of the key findings. As Andrew said, CalPERS is a global leader in sustainable investing. It consistently tops best practice surveys. It consistently tops league tables. Its PRI assessment score puts it into certainly the top decile compared to other asset owners. CalPERS wins prizes. Responsible Investor awarded it its inaugural award for innovation and industry leadership for your 5-year strategic plan. And the Bretton Woods Responsible Asset Allocator Initiative, which is based on 10 core principles, rated, again, CalPERS as a top quintile performer alongside your peers such as CalSTRS and New York State Common Fund. Slide 9 goes into, what are those practices that makes CalPERS a leader? And during our kind of review and research, we found a number of different areas that I can't fully do justice to all of them, and I'm sorry to staff for not being able to go into each of those. There's some fantastic work being done. We really just want to pull out one example here, which is around the real estate team, their Energy Optimization Initiative, EO. Slide 9 gives you a little bit of detail on that. And this is really important because, looking at these longer term risks, the building sector accounts for around 1/3 of the world's energy consumption and greenhouse gas emissions. And the real estate team spotted here some low-hanging fruit, really, in terms of energy savings. And that's what we liked about this example, is there's a kind of tangible link to risk and return from this ESG integration project. So following extensive stakeholder consultation, the CalPERS real estate team, they added a total of 20 energy optimization projects to the 17-18 annual investment program. And the team expect a combined net present value of savings from those energy projects of around $14.8 million. And look, it's worth pointing out this project is in its infancy, it's in its early stages, and the goal is to become more systematic in terms of monitoring those benefits. But I think what's important to note is that those are real savings which will be seen, which will show up in lower operating expenses for the relevant assets. Switching back now to the slide around recommendations, slide 16, and this really kind of hopefully brings to life what we're trying to get at on the third area, which is how can we look at best practice examples like the Energy Optimization Initiative and encourage more of these? How can we encourage more of these type of projects which clearly link to risk and return within the culture of how CalPERS is being run? So can we begin to see staff being incentivized, sufficiently empowered to step outside of their day-to-day sort of responsibilities and seek to reflect on and contribute to these type of ESG integration projects? And to help address this, we actually recommend CalPERS set a clearer expectation on the levels of formal and informal training for staff to further their investment knowledge, and similarly for investment staff to broaden their ESG skill set. So we'd recommend signaling the importance of ESG integration practices in staff's future career development and reward the implementation of ESG integration initiatives. Coming back to the first recommendation around strategic objectives, I think this is perhaps the most important, but perhaps the hardest. We've talked about CalPERS having an award-winning 5-year strategy, and we know that the process that you all went and undertook to develop that strategy was extremely comprehensive. And so we felt that, talking to staff and others, that now we're at this kind of midpoint of thinking through what are our long-term objectives on ESG. This might be quite a good time just to take stock, to try to think about what lessons have been learned. How has the plan stacked up? How's it stacked up in terms of thinking through some of these kind of emerging risks and opportunities and issues which perhaps weren't on the plan when the plan was first conceived but have since emerged? like the Sustainable Development Goals, like other issues. So, you know, one of the things that we're keen, you know, committee and others try to think through is, as we're setting new strategic objectives, can we more clearly link those strategic objectives to resources and to implementation? And I think what struck me actually out of the peer review, if we could just flick to slide 10, and just to be clear, the peer comparison here, that, you know, the idea is we're not trying to highlight areas that CalPERS does or doesn't do. You know, we've talked about CalPERS being a leader. Yeah, that's a good slide for now. Oh, that's right. They're off by one, so excuse me. This is slide 11. And what we're trying to do is really highlight what others are doing rather than necessarily focus on what CalPERS isn't doing. And so on slide 11, the box there's interesting to me in that it actually shows an example of what I've just referred to, which is another asset owner very clearly setting their criteria for new strategic objectives which come onto their long-term planning. And so every new addition to a plan would have to pass kind of three tests, three criteria. I thought that was interesting. Slide 12, if I got my numbers right, actually goes into kind of the resource and delegation. Sorry, we'll flip on one more to slide 13, if I may, which is people. So this kind of, just taking a step back a little bit, there are differences in the way that PRI signatories respond to their assessments. You know, the survey itself is kind of designed to be standardized, and people answer the same question in different ways, which doesn't necessarily always help, but we know the whole process is bedding down. And in CalPERS' case, this, we know, overstates the number of employees. We know that if you break down the 38 here, it's actually made up of a lot less. So we spoke to the team and went through the numbers which break down that there's certainly around 18 which are full-time employees, 10 in the global equity team and 8 in the sustainable investing team, and the other 20 actually touch ESG in some way or another. And you'll see there, you know, the Canadians actually, Public Sector Pension Investment Board, for those kind of equivalent of the other 20, they say we have 2 that spend 12.5% of their time on responsible investment. That's very exact, clearly. But actually what's interesting about this is that perhaps there are lessons we can think about on trying to have a better handle on how the sort of non-dedicated ESG staff are spending their time. But the point here on this slide is that CalPERS is well-resourced in this space, and that's clearly what's helped it, a large degree, to deliver its leadership position. So I think really, you know, what we're trying to get at here is that we do recommend taking stock on this 5-year plan, trying to prioritize emerging ESG issues as they come online, to consider the resource implications of new ESG issues, and importantly help to translate those ESG issues into investment terms. And we like the example of appraising each ESG issue according to a predetermined set of criteria, including the potential risk and return impact on the fund and the staff and resource commitment for each ESG objective. Just going to switch back to the last recommendation here. So this is very much around the middle recommendation on 2, clarifying leadership roles and responsibility. So here we're wondering whether, you know, have we got the right balance of ESG integration resource and efforts which are focused on you know, the individual asset class teams? How well is that being coordinated across the firm? Are we being sufficiently clear to stakeholders about how ESG objectives flow from the top in terms of the ESG plan all the way through the organization? And I think, to me, what was interesting about slide 14, I've probably got my number 1 off, so it's slide 13. It's not, it's slide 12. Actually, here, it actually just shows the bottom table's more interesting, but some of the other funds that are out there, actually, they have one responsible individual, and some of the other funds have multiple responsible individuals for ESG. So CalPERS is in the multiple responsible individuals, highlighting that multiple managing investment directors have accountability for ESG. And then we know that others, University of California, appoint one person. So really the point here is just the difference in approaches, appointing one person and having a more sort of decentralized approach for accountability. Are there some things we can think about as we have multiple staff responsible that we're clear around who is in charge of delivering which aspects of the ESG report? So I think really, hopefully that gives you a sense of our findings, CalPERS' leadership position that we hope will continue to be cemented. Over time, we do feel thinking through these three core considerations can help it to sustain its leadership position over time, and would welcome any questions on our report.
Yeah, thank you very much for the report. And this is the first one, and we're pleased to see that you have started your process to deal with the ESG issues, because it's a very important part of our processes now. So we look forward to continuing this dialogue and discussion with you as we move forward. I have one question on the anticipated net returns of $14 million, I think it was in your chart. You know, many times we receive proposals or new plans that come before us to be implemented, and it talks about outcomes and goals. What I've been asking is that how do we verify those outcomes and those goals? So how do we verify the 14 million has been achieved? So what mechanisms are going to be provided so that we could evaluate whether or not those goals are have been met?
Yeah, so I comment particularly on that cost saving itself. So that particular 14.8 million cost saving will be realised in improvements in the real estate team's net operating income for those assets. And we know that net operating income is a driver of the fair market value of CalPERS' real estate assets. So we should see those savings show up in both the net operating income and the fair market value. In terms of kind of broader efficiency savings and that kind of cost versus benefit analysis of different ESG integration innovations, I think absolutely this is core to us kind of tracking and demonstrating the efficacy and attribution of ESG within the investment process. So the more that we're able to capture the benefits as well as the costs in a more systematic way, perhaps we can learn lessons from this particular case study for how CalPERS might want to approach it for different asset classes.
Okay, thank you. Mrs. Mather?
Thank you. I was intrigued by the peer group example of strategy setting that you identified about the Caisse de dépôt. And I'm wondering, maybe can we sort of go through what a real life example might look like? And one of the issues that has arisen recently as an investor issue is around sexual harassment, sexual violence in the workplace, retaliation. And obviously we saw with the Wynn company that it lost, what, $3.5 billion as reported by Forbes in January of this year as a result of allegations that are claims that have arisen around Steve Wynn's sexual harassment history. Similarly, we say the Weinstein Group has suffered considerably. The Weinstein Company suffered considerably and has filed for bankruptcy as a result of Harvey Weinstein's activities. Anyway, so clearly there's some investment linkage there. There's a loss in value for shareholders of these companies. And I'm wondering how you would take that as an emerging issue and use these criteria to determine whether and how to incorporate it into our own strategic plan.
Yeah, so I mean, obviously the challenge with kind of setting criteria is kind of would need to be an evolving process. I know that CalPERS' investment beliefs perhaps could help act as a guide, as an anchor to help through its thinking through the steps of what new issues could be relevant and indeed what could be financially material to the assets. I think with that in mind, you know, when we wrote our paper, we focused on one risk that ESG certainly has an impact in, and that is around drawdown. So we went through a number of examples of how, particularly on the governance side, funds may be exposed to increased drawdown risk from some of the governance factors. You've talked about issues which I think are very much around corporate governance, around culture, around providing checks and balances. So, you know, one of the things you could do is look to see what kind of what the exposure is, perhaps to some of these practices. Looking through kind of an ESG ratings, we can get to perhaps, you know, highlight some of those individual security examples and kind of, you know, stress test the portfolio against those kind of risks. I think the challenge is when you try and step up to look across the portfolio, how you would go about doing that. But I think having a kind of exercise where every time there's a new issue, looking through the portfolio, looking at exposure and testing the sensitivity to drawdown risk, I think is a helpful approach.
And I would just add, I think that just like our annual reviews are still developing, and we're going to incorporate the feedback that we get today to make next year's more fulsome and continue on, I think this whole field is continuing to develop. And it's easy to find, as you named a couple of examples, you could throw Wells Fargo into the mix, right? It's easy to find sinners that are punished. It's harder to find, you know, good ESG practitioners that excel, because they don't have the same magnitude of outperformance that we see in the underperformance when something really comes to light. So I think that'll be one that we'll take away and try to figure out how to present a more balanced perspective to highlight some of the pros and the drawdown risks, if you will.
Yeah. But certainly in terms of, I would think of in terms of crafting an engagement strategy, looking at the downside risk, the drawdown risk, litigation risk, financial risk, all of those things might be things we would want to consider in developing a strategy.
I think that's absolutely right, and I don't know whether we can pull it up, but you know, some of the board members know this extremely well around kind of the three different approaches to sustainable investing, and you know, sometimes it's worth kind of reminding ourselves that I'm not even going to try and number the slide for. Okay, good. That we have different tools in the toolbox in this area, and I think, you know, a lot of the conversation has focused around what you know, perhaps spotting those losers or wanting to avoid those potential losers as a result of a particular mission or view on the kind of left-hand side of the column. This review is very much at the core of trying to focus on the middle of the column around ESG integration, and this is about identifying ESG risks, still perhaps taking on those ESG risks as long as we're being sufficiently financially compensated for doing so. And I think the key to taking on those ESG risks is corporate engagement and stewardship. And I think the more that we're able to demonstrate the efficacy of stewardship over time with hard, real objectives for delivering change at individual companies, the more that we're able to lend kind of credibility to the ESG integration approach.
Thank you.
Good. Ms. Paquin?
Thank you, Mr. Chair. Thank you for the report and appreciate the report. I had a couple of questions about your recommendations. And one, you suggested establishing an ad hoc working committee to review the strategic plan on a regular basis. And then you also pointed out making sure that responsibilities are clearly aligned and identified and defined. And I know the Investment Office over the past year have been doing a lot of work along those lines to make sure that everybody who's responsible for ESG is clearly aware of what the expectations are, and there's been a number of new committees established. So are you suggesting that there needs to be more work done along those lines in another committee, or what are you thinking?
I wouldn't be suggesting another committee. I don't think that's necessarily what's required. I think certainly from my interviews and discussions over time, there's a willingness to let the existing processes kind of bed down, and I think recognizing that no kind of structure is always going to be kind of perfect. I think it's working within the structures that are there and improving the kind of coordination and communication, frankly, across different asset classes, different skill sets, different backgrounds. What are the best means by which to bring people together, to share ideas, to innovate? I'm not sure there's necessarily an optimal approach to that. We focused on one or two things that we think would help, which is more carrots rather than necessarily sticks. So, you know, do people feel that taking on an ESG project is going to be good for their career, is going to be good for their growth within an organization, for developing their skill set? Those type of things that you know, within training, within hiring staff, setting the expectations clearly to them that this is part of your career development and the expectations in this area. We think those things will perhaps have a good impact on kind of the coordination and communication that we're trying to encourage.
And I agree with you. I think those are very important as far as the investment office culture. I just wanted to make sure that you weren't, you know, I think when this process was first put together, there were a few bumps in the road as there are when you're establishing something new. But from your review currently, I just wanted to make sure that you were comfortable that going forward that process is working. And
So I think that's kind of at a more sort of implementation level. What we're trying to talk a little bit about here is what happens going forward in terms of setting strategic objectives. So is there sort of further scope for more collaboration, not so much within investment staff, but also across kind of different aspects of the organization in setting its strategic objectives? And I think this translation point is pretty key, which is, as new objectives come onto the plan, are they kind of are they ready to implement? Have they been kind of translated for investment staff? And I think that's what we're talking about. It's, whether it's an ad hoc committee or a kind of working group, it's up to sort of further discussion. But having something which kind of really takes stock and reviews how we got to where we are, what's worked, what hasn't, and what could be improved on, I think could be a helpful initiative going forward.
okay, all right, thank you.
Okay, Ms. Brown?
Thank you, Mr. Chair. Mr. Junkin, we talked a little bit, I think last week or the week before, about this report, and so it's no surprise that I have a couple of concerns about this report. Again, we're talking about objective evaluations, and I do have a concern that we're using the PRI scorecard because it is a self-assessment. Mm-hmm. And the first time I saw that was in January of 2018, and right in there, there's a little warning that says that this is not audited, and we provide no warranty, and do not use or rely on this data. And I don't know what page it's on in that first PRI report. So I'm concerned that we're taking that data that they say is unaudited, and then we're using it to evaluate ourselves. I just want to be clear to say that publicly. And also, I really have concerns with winning prizes. I think that's very subjective, especially in the first year. I mean, if it's a Pulitzer, I'd say awesome. But this is our first year of this, and I have concerns when we use subjective things to evaluate how we're doing with ESG.
I'll just add what my crystal ball tells me about ESG, and in some ways it ties back into what Ms. Paquin was talking about. I think that I mentioned I've been working with CalPERS for 13 years now, and I've had the pleasure of working with 4 different CIOs. You think about that, a generation within CalPERS, it's maybe not 3 years, but within the entire investment staff, 10 years from now, ESG is going to be fully integrated. There's not going to be how do we make this process kind of work better. I think the industry is going to come along the way as well. And just as we saw, well, I don't know, 25 years ago, the CFA Institute, back then AIMER, put together GIPS compliant standards about how to report. I think you'll see some industry movement along the way to try to get to that same point. And we've seen it with, and I've completely blanked on the name of the organization that's...
the SASB, the Sustainable Accounting Standards Board.
Yeah.
Right.
SASB is certainly taking a big step that way, a big leadership position in terms of trying to get all companies to report on a similar basis, so that as an investor, you can even say, well, wait, if Exxon reported this way and Target reported this way, is there a way to make an apples-to-apples comparison despite the fact that they're in entirely different businesses? So I think that this is going to be a field that grows and evolves considerably. The other thing that we talked about was, are we getting value for our expenditures? And
I was going to ask Mr. Eliopoulos.
Okay, I didn't mean to steal your
because we don't
thunder.
know what those expenditures are. At least when we last met Mr. Eliopoulos, we talked about how many staff, what's the FTE. You did mention you have some part-time staff, how much are they working? But really, what is that costing us a year in terms of staff time, travel, consultants, all that? And what is that costing us, and do we think there's value for that investment? And we still don't have those numbers.
I was careful not to jump in on the consultant's time. So I think on the resource question, this is the first year we've done our annual review. That's coming up in 6B in a few moments now. We did not include the slide that we have in the other annual reviews for the other asset classes that would list those resource costs. And that's a good point, and one we will include in the future. And I'm looking to see, I'm not sure whether we've been able to calculate those numbers presently, but we'll cover it in 6B if we have all the information that we have today.
Appreciate that.
Yeah.
Thank you, Mr. Chair.
Okay, thank you. Okay, Ms. Hollinger?
Thank you. Appreciate the report. Just one or two questions and some commentary. I wanted to know, when you were doing the ratio of staff to ESG, does that factor in that certain organizations may outsource it?
Yeah. So one of the slides, sorry, Andrew, is around proxy voting. There you go.
Right, I saw in relation to proxy voting.
Next slide there, around proxy voting. So, here is a particular strategic choice which has implications for resources. If you choose to vote your proxies in-house and engage with portfolio companies in-house, you can be slightly more nimble, perhaps, in terms of the full-time employees you recruit on ESG, and whether that's the core motivation for those who are yes in this camp, or whether it's an efficiency story or otherwise. There are clearly trade-offs, and CalPERS has made a strategic, clear decision to vote its proxies in-house. So I think the point is that the differences in full-time employees can be often explained by strategic decisions. Hence our point that the more that we're able to link the two strategic decisions with resource implications together, the more efficient we can be at utilizing that existing resource.
And then my other just commentary, I think really the governance structure drives the E and the S. If you don't have good governance, you're probably never going to get to E and the S. And I thought with what Ms. Mather said regarding either gender discrimination or harassment, I think it's a suggestion that maybe we ask key executives to disclose the pay between the women and men on the executive level, because I think as people are compensated equally, it'll lead to better governance. So disclosures on pay. would be a suggestion. That would be something that you can't check the box, as Ms. Brown points out, and we wouldn't have a way to audit it. We could just get it out there.
Okay, Ms. Taylor.
Thank you, Mr. Chair. I really appreciate the report. It was very, very good. It gave us a good idea of who we compare to. And I had a couple of questions on the proxy voting. I think we have this great proxy voting that we're doing. What was it? It was 504 just on, I'm trying to find the slide right now. Come on. There we go. Just on the lack of gender and diversity. And as Ms. Hollinger and Ms. Mather were talking about, I'm wondering if, and I don't know if you had any conclusions about this, but not just doing our proxy voting or writing letters, are we picking institutions or people we invest with to engage in at the same time we're doing this? And is that an objective or a strategic plan to maybe get to disclosure of pay? And I know we used to really push, I think it was my first year on the board, we were really pushing disclosure on executive pay to get that data. And we were doing that through letters, we were doing that through our proxy voting, as well as doing that through engagement. So I think I'm not seeing here in your report where we have a lot of intertwining of those strategies. And I'm wondering if that would be part of a better strategy moving forward. As you said, we were looking at, more leadership. I think that would be a huge leadership role for us if we intertwine those strategies. And how we do that as we implement it into the entire fund. I don't know, you mentioned resourcing. I know that we have a lot of resources, it looks like, but I'm wondering if that resourcing is misallocated and that we're separating things into silos. So like we have our letter writing campaigns and we have our proxy voting and we have our engagement, but it's all separated into silos because we're engaging through our asset classes. Mm-hmm. So does that impact how effective we can be?
So I think it's a really helpful question and a challenging one for the organizations I've worked with and worked within. Perhaps the hardest sort of element of all of this is linking back the kind of engagement and stewardship work into the investment process. I think what we've seen over the past year, the changes taking place with bringing that within the equities team. I think we're seeing it all sort of begin to bed down, new recruitments coming in. I think it's a constant challenge, and I think the team are doing some great work. We highlight one example of what we thought was really great practice for CalPERS, which really, I think, came forward last year, was the Exxon Mobil vote.
Right.
As a sort of the logical conclusion to what started off as work around from the sustainable investment team undertaking carbon footprinting of the public equity asset class, and then in a highly innovative move undertaking carbon footprinting of fixed income, which hasn't, as you know, I don't think been done by many other asset owners. That work led all the way through to this really focused, intensive engagement work with carbon-intensive companies. And I think, to me, that's a very good example of thinking through a kind of core strategic objective, going through the analysis, what's our exposure, all the way through to delivering change at a particular company level, which has repercussions across the industry. And the more that we can kind of bring all that together for other issues like the ones you're talking around pay and others, I think that's where we'll have full integration.
Right. So basically, maybe breaking down those silos is what you're talking about, because it sounds like the Exxon example you're giving us did break down those silos, and they worked together with the engagement, proxy voting, and letter writing campaigns. So I think that's why we were so successful. So I'd love to see us do that on our, as we move forward on sexual harassment or executive pay, if we can. But I think this was a great way of outlining what we are doing so that we can see what we need to do moving forward. So thank you very much.
Okay. Mr. Costigan.
I'll be very quick because I know we have another item coming up. First, I want to thank Chair, Madam President Mather for raising the issues as it relates to those two individuals. I do think it's one thing that we should be looking at. They do have long-term implications when you go back and look at settlements that occurred decades ago that suddenly drive down the stock prices. And so that is something I think thank Ms. Mather for raising that. A couple issues just on the report, and again, I do like the report. It's one of the issues that I've raised over the last couple of years. I appreciate that we sent 504 letters on diversity. I really think the policy, and at some point, as I've raised before, we have 25,000 board seats, not including those on private equity. We really need to look into a policy. If you're serving on more than 3 boards, I know it's an informal process, you're getting voted out. I mean, what we're seeing is we use the word diversity, then when you peel back into it, you see it's similar individuals. The other thing I also think is very important is educational diversity. When you start looking back, they tend to be from the same Ivy League, Stanford, Cal schools. If we really want diversity, it's more than just gender. It's more than just the color of skin. And I would certainly hope that Ms. Mather and Mr. Jones, that we would broaden it, because there are many qualified people who have gone to other schools that I don't think are given the opportunity to it. But I really do think down the road, the policy, rather than sending letters, and I think Mr. Juarez and I had this conversation several months ago. I was picking on a certain individual on a financial services board, and he pointed out to me the skin color. And I said, that's exactly the point I was making, because that individual is on 6 boards. That's not diversity when it's the same individual. So I would certainly hope we end up with a policy with 25,000 people, or 25,000 board seats, not including, again, those on our private equity, because I don't think your report really addresses private equity boards. When we start looking at the number of seats, and again, going back to the educational diversity. So again, Ms. Mather, I really appreciate it. I do think we need to have a more formal policy. The Weinstein and the Wynn issues with the hundreds of millions of dollars of equity that was wiped out once the settlements came out, I'd like to know where the boards were and what their obligation and responsibility were to investors such as us. Thank you.
Okay. Mr. Miller.
Yes, thank you. Appreciated the report. As a relatively new board member, and I can only get away with qualifying my statements that way for a little longer, so I'm going to continue to do it as long as I can. But I think what I would be interested in seeing, especially going forward more, is, and it'll be, I'm sure, part of a dialogue between staff, our leadership, and consultants, is we have stood out as a leader. We have committed resources. We're, I think I would say well-resourced. But in terms of moving from aligning those resources to really, how do we really integrate them? How do we get everything across the organization kind of, aligned and integrated to actually function? And the impact that will have on efficiency and effectiveness, which kind of makes that a moving target, the resources. So I'll be real interested going forward, I think, our attention to how do we most effectively integrate as we've aligned things to optimize, where we put our resources before we get too far down the line. At some point, we're building, now we need to optimize before we throw in a lot more bricks and mortar. So that's kind of what I'd like to see more focus on as we go forward.
Okay. Okay, thank you very much. We do have a request from the public to speak on this item. Mr. Michael Ring from SEIU, if you can come down to the speaker's bench, as we call it, and
while he's coming up, could I just make one comment to Mr. Miller? I put it back on the personnel slide for a minute and took it away, and that's fine. You don't need to put it back up. I think as part of that evolution that I see going on, I think that slide will be impossible to do in 10 years. I think ESG will be so integrated into what everyone does across this investment office and other investment offices. I don't think it's going to be CalPERS specific. I think it's going to be hard to count FTEs when it's part of everybody's job and it's fully integrated.
Okay, thank you. Yeah, Mr. Ring, you please state your organization or association, and you will have 3 minutes, and the timer is right here that you can help monitor your time.
Thank you, Mr. Jones. Thank you, members of the committee. Michael Ring with the Service Employees International Union Capital Stewardship Program. 3 points I'd like to share with you. First, I want to thank Wilshire for the report, and I want to congratulate CalPERS Investment Committee and the staff for your leadership in the ESG area and the 3 forms of capital, and figuring out since the time you adopted the investment beliefs how you use your resources to manage these most fundamental of systemic risks. You know, CalPERS commitment to ESG to me and our organization indicates that you understand that the biggest risk to paying the benefits to our members is a systemic risk. We can't have another market meltdown like 2008. We can't have an energy sector that can't deliver energy going forward. We can't have workers who can't make a living because then they can't buy products from the companies we're invested in. Systemic risk is the one thing that actually could threaten the future of this fund, as opposed to a lot of other things that are said about it. So I really appreciate the investment in this area, and our leaders do as well. Second, I want to note that while labor unions, it might not be surprising that we feel that way, it's not just us. I mean, Larry Fink, in his latest letter to CEOs, indicated that social purpose is the fundamental thing that companies must figure out. The World Economic Forum, hardly noted as a progressive organization, rather as the global elite, indicates that systemic risk is the fundamental threat to the global economy. So I don't think you're out on a limb, and as Mr. Junkin indicated, this is where the world is going, because we have to figure these things out in order for a fund the size of CalPERS to be able to invest $3, hopefully $4, hopefully $500 billion inside the global economy. Second, I want to support Wilshire's suggestions and that the staff and the board and the committee continue to work to integrate and align the work. I think this is challenging. You're going through a lot of change. Mr. Iliopoulos has led a lot of transition that's led to great integration. The one area that I think we would flag is that it's really important that CalPERS continue to dedicate resources to working and mobilizing other investors. There's no one investor that can manage systemic risk. It's got to be a coalition of investors who share the interest in long-term value. And lastly, while there's way too many people to recognize for CalPERS leadership in this area over the years, I do have to recognize one person. I know for the last decade that I've been paying attention to this fund, that Ann Simpson has just done a marvelous job of bringing innovation, creativity, and groundbreaking thinking, not only to this fund, but to the world's thinking in this area. And it is a real opportunity and gift that CalPERS has to have someone like Ann on staff, and I think our leaders and our members really appreciate the work she does to help make sure that the benefits will be there when they retire. So personal and professional thank you to Ann and to all of you and to Ted and his team. Thank you very much.
Okay, thank you, Mike. We are scheduled to take a break in about a little over 30 minutes. And so this next items is certainly going to take some time. And in order to have continuity, I'm going to take a break now for 10 minutes, and then we will reconvene. And that way, when we start the next item, we will have the continuity going forward. Okay. That's good. Okay.